I'm Bryan McNee, Senior Bond Analyst for MBS Authority, reporting for MPA TV. Today is Monday, September 9th, and here is your weekly overview for mortgage-backed securities. We monitor Fannie Mae, Freddie Mac, and Ginnie Mae mortgage-backed securities because those are what ultimately control your fixed interest rates. So let's take a look at what happened last week. Of course, we had a holiday-shortened week. Mortgage-backed securities lost 78 basis points. That's bad news for mortgage rates. If you look at the line chart up here, the candlestick chart, in this direction, if mortgage-backed securities trade over here, that's good for mortgage rates. If mortgage-backed securities trade down here, that's bad for mortgage rates. In fact, last Thursday, if you take a look, mortgage-backed securities, particularly the Fannie Mae benchmark coupon, the 4.0 coupon, hit the worst levels in the last 36 months. That means you hit the worst mortgage rates in 36 months last Thursday. Let's take a look briefly at what happened. Essentially, you had better than expected economic news. Strong economic news usually leads to some type of economic growth, and bonds don't always react too well to economic growth because that means inflation, and bonds hate inflation. We had very strong ISM manufacturing, ISM non-manufacturing in the servicing sector, strong auto sales, and a few other reports that just showed some strength in the economy. As a result, mortgage-backed securities sold off. We also had a pullback in sort of that fear factor premium that Syria had created 2 weeks ago. Remember, 2 weeks ago we had sort of a lift in mortgage-backed securities, which gave you a little better interest rates due to the fear and concern and uncertainty of the unintended consequences of an attack against Syria and what that would mean to the global financial structure. Last week, that concern over an attack abated and pulled back as it became very clear out of the G20 meeting that Obama simply did not have any international support to launch an attack. And so the market believed that there would not be any type of military action last week, and as a result, that fear factor pulled back. Now, what did we see on Friday that were sort of reversed some of that? Well, we saw a weaker than expected non-farm payroll report. Yes, the unemployment rate dropped slightly, but that was due to the participation rate falling, not due to a tremendous turnaround in the employment picture. Traders don't really look at unemployment rate anyway. They look at the non-farm payroll, and non-farm payroll came in much less than the market expectations, and in fact a lot lower than the whisper numbers on Wall Street. But still, it was a halfway decent number when you take a look at all the readings that we've had over the last 12 months. But the prior month was revised downward so much that it just couldn't be ignored. Mortgage-backed securities had a nice bounce as a result, and we picked up a lot of lost pricing. Still, for the whole week, we lost some ground. Now, what's on the agenda for this week? Let's take a look at the calendar. We've got a pretty decent week, particularly capped on Friday with some big ones such as retail sales and PPI to take a look at. But throughout the week, we've got a big dose of treasuries that are going to hit the market, in particular the 10-year treasury note and the 30-year treasury bond to contend with. But Wednesday is going to be that key day. Not only is it the 10-year treasury day, but also that's the day where we're supposed to have a vote in Congress on whether to attack Syria or not. We'll have to see how that unfolds, because if we move forward, or if the market believes that we're moving forward in that direction, then what you're going to see is sort of that fear and concern over the unintended consequences move back into bonds. That always lifts bonds, because bonds is sort of that temporary safe haven for fear and concern. So you might see some rallies in bonds as a result of any official vote to do anything as far as military action in Syria. We'll have to sort of see how that plays out. That would be the one sort of opportunity for pricing to improve. But if we don't move forward, and it's the third week in a row where we're not moving forward, then market participants are going to further sell off their positions in bonds that they got into solely for safety purposes. And so that's the risk versus reward there. Wednesday will be very key for sure. And retail sales on Friday will be very key as well. We'll just have to keep an eye on everything. But it could prove to be a very volatile week, particularly with the international picture that is built into mortgage-backed securities.